What are the fundamentals of financial independence? Here are some important strategies that an advisor may develop with you to help you achieve financial independence. Separate your savings from your investments. Before you begin to invest for a long-term financial goal, you will need to save for an emergency fund, up to 6 months' worth of your salary. Then you are better prepared for an unexpected expense, such as an engine job on the car, a leaky roof, or loss of employment. Otherwise, you may need to tap into your investments that are intended for retirement or some other purpose. Budget based on your income, not on your desire. Plan to spend less than you earn and don't take on debt that cannot be serviced by your future income. Budgeting is based on your income, not on your past spending habits. Total your monthly expenses such as housing, utilities, food, clothing, childcare, transportation, and debt repayment. This sum should not exceed 75% of your after-tax income. Invest by paying yourself first. You will only beat the habit of procrastination if you focus on paying yourself first. A rule of thumb: save 10% to 20% of every paycheck. This may be achieved by purchasing units in good investment funds or segregated funds over a long-term, systematic basis, using your bank's automatic payment program. Use beneficial debt to build equity. Minimize and pay off consumer debts, monies borrowed to purchase cars, clothing, vacations, stereos, and other gadgets that decrease in value. Debt to get an education or mortgage a home is acceptable debt. Only if the interest rate is very low and repayment is affordable, debt for investments such as investment funds, your own business, or blue chip stocks may make sense. The interest on such investments, if not held in an RSP, is tax deductible. Differentiate your risks. You can only beat inflation risk with long-term investment risks such as equity investment funds that purchase the stocks of many companies. They are not guaranteed, meaning there is a risk. Yet equities have a much better chance to outpace the other risk, inflation, when compared to a savings account over long periods of time. Inflation is the single greatest long-term risk. At 4% over 20 years, inflation will cut the value of today's purchasing power by half. Determine to diversify. A properly diversified portfolio will hold several types of funds, including a good proportion and mix of equity funds. Equity funds should differ in terms of what part of the economy they invest in, such as agriculture, technology, resources, or finance. Though each fund would hold many stocks, make sure they are diversified among the various sectors. One sector may gain while another may lose some value, balancing out over time. Equity funds can also diversify by country, such as holding domestic, U.S., and global funds. Investment style, such as growth funds or value funds. Or company size, such as small, mid, or large cap. Consider adding bond funds to the mix to diversify even more. Optimize your portfolio. If you can optimize your portfolio, you can minimize risk and maximize return. To truly optimize, one needs in-depth knowledge only attainable from a professional whose job it is to study investment funds as a specialty. To diversify in a balanced manner, one needs to weigh many factors in relation to economic sectors, managers' styles, company size, and foreign economic conditions. Talk to your advisor before making any financial decision. The publisher, AdviceOn, offers this service for educational purposes only.